My greetings to everyone. I am Professor Namita Rajput, Professor in Department of Commerce, Sri Aurobindo College, University of Delhi. In the ongoing series of corporate governance, today we will be talking on institutional investors and what impact it has on the corporate governance. So here we will be discussing some ways the institutional investors, how they impact the corporate governance. The first is your active ownership and engagement. Institutional investors, they often engage directly with the company management and the board to discuss the performance, strategy and the governance practices. So this may involve the meeting and the dialogue, the regular interactions and the company executives and the directors to discuss the business strategies and the governance issues. The next is your shareholder proposal. Submitting the proposal on the various governance issues like executive compensation, board composition and the environment of the social policies. The next is your voting. Exercising the voting rights on important issues during the annual general meetings, that is AGMs, such as electing the board members, approving the executive compensation packages and other significant corporate actions. The first is your proxy voting. Institutional investors have the responsibility to vote on behalf of their clients or the beneficiaries. They often have a dedicated team to analyze and decide and how to vote on a wider range of issues. Using their influence to promote a good governance practices, proxy voting can cover the topics like board elections and executive compensation. So when you talk about a board election, voting on the appointment or the removal of director, and when you talk about the executive compensation, approving or rejecting the executive pay packages. The next is your mergers and acquisitions, supporting or opposing a major transaction. The corporate policies, influencing the policies on ESG, that is environmental, social and the governance issues. The governance code and the principles. Many institutional investors, they adhere to the established governance codes and the principles that guide their engagement with the companies. For example, it includes the principle for responsible investments, that is PRI, the investor stewardship, the group stewardship, the principle and the country specific codes like the UK Stewardship Code. Now, these framework provides the guidelines on the transparency and disclosure. When you talk about this particular aspect, it ensures that the companies provide the accurate and the timely information to all the shareholders. That's how the transparency and the disclosure is at the center of the institutional investors and the corporate governance. Next is your board accountability. Promoting the independence and effectiveness of the board is also one of the key issues. Then is your risk management, that is ensuring a robust risk management and oversight practices. The next is your collaborative engagement. Institutional investors, they often collaborate with each other to amplify their influence on the corporate governance. This can involve forming the coalitions or working groups to address the specific issues. Now, these examples include, like for example, the Climate Action 100 Plus, a group of investors working to ensure that the world's largest corporate governance greenhouse gas emitters take a necessary action on the climate change. Next is your investor network. The network, like the Council of Institutional Investors, that provide a platform for the investors to share the insights and coordinate the actions on the governance matters. Next is your long-term value creation. Institutional investors typically have a long-term investment horizon which aligns their interest with the sustainable corporate practices. They advocate for the strategies that contribute to the long-term value creation, like sustainable business practices, encouraging the companies to adopt the sustainable environmental practices, the social responsibilities, and the sound governance structures. The capital allocation, promoting a prudent capital allocation decisions that balance the short-term returns with the long-term growth. The next is your risk oversight, ensuring that the companies have a robust system to manage and mitigate the risk. The next is your performance monitoring and evaluation. The institutional investors continuously monitor the performance of their portfolio companies, assessing not only the financial metrics but also the governance qualities. This includes the performance matrix, evaluating the financial performance, operational efficiency, and the strategic execution. The next is your governance assessment, reviewing the board effectiveness, management quality, and adherence to the governance best practices. The next is your ESG integration, integrating the ESG factors into the investment analysis and the decision making process. When you talk about the influence on the regulatory and the policy developments, institutional investors can play a very critical role and influence the regulatory and the policy developments related to the corporate governance. They engaged with the regulators, with the policy makers, and the industry bodies to advocate for reforms that enhance the transparency, accountability, and the shareholder rights. Next is your activist investing. Some institutional investors, known as activist investors, they take a more aggressive approach by acquiring the significant stakes in the companies and pushing for the specific changes. This can include restructuring of the management changes or the strategic shifts to improve the performance and the governance. So, we can say that the institutional investors, they play a very critical role in shaping the corporate governance practices through active engagement, proxy voting, adherence to the governance codes, collaborative efforts, and focus on long-term value. They help ensure that the companies are managed in the ways that will benefit the shareholders and other shareholders while promoting the ethical and the sustainable business practices. Now, coming on to a very important topic, that is, what is the impact of institutional investors on the stock prices? The institutional investors, they significantly impact the stock prices through their trading activities, investment decisions, and engagement with the companies. Their influence can be seen in the various aspects of the stock market, including the price stability, volatility, liquidity, and the long-term price trends. So, we will be looking on the different ways the institutional investors, how do they affect the stock prices. The first is your market liquidity. The institutional investors, due to their large trading volumes, it enhances the market liquidity. Increase the liquidity typically leads to the tighter bid-ask spread and smoother price discovery process, which really helps to stabilize the stock prices. However, their large trades can actually cause a short-term price momentum, especially in the less liquid markets. Next is your price efficiency. By conducting the extensive research and the analysis, the institutional investors, they contribute to the efficiency of the stock prices. They quickly incorporate the new information into the stock prices through their trading activities, helping the market reflect the true value of securities more accurately. This process, known as the price discovery, it ensures that the stock prices align closely with the underlying fundamentals. Impact on volatility. The trading behavior of institutional investors can both increase and decrease the stock price volatility. Increased volatility. The large trades by institutional investors can actually lead to significant price movements, particularly if the trades are unexpected or if they occur in less liquid stocks. High frequency trading by some institutions can also contribute to a short term volatility. The next is your decreased volatility. On the other hand, when you see the impact of institutional investors on the stock prices, there is a decreased volatility. Like the presence of institutional investors can actually reduce the volatility by providing the liquidity and stabilizing the prices through a long-term investment strategies and more predictable trading patterns. The market sentiment and the trends. Institutional investors, they often set the market trends due to their substantial influence and the perception that they are well informed. Their buying and selling decisions can signal the market sentiment or other investment, like for example, momentum investment. When institutional investors, they collectively buy the stocks that are performing very well and sell those that are underperforming, they can actually drive and reinforce the market trends, which is contributing to the momentum in the stock prices. So, definitely, when you talk about the institutional investors on the stock prices, what influence they have on the stock prices, this momentum investing is a very, very prime factor. The next is your herding behavior. Sometimes the institutional investors, they follow a similar strategies leading to herding behavior. This can actually accelerate the price movements, either driving the prices up during the period of optimism or pushing them down during the market corrections. Now, the next impact what the institutional investors have on the stock prices is the performance. Institutional investors, they actively engage in the corporate governance and can positively impact the stock prices over the long term. So, by advocating for a better management practices, accountability and the sustainable business strategies, they can actually enhance the company's performance and consequently its stock prices. Improved corporate governance practices tend to attract more investors and potentially leading to a higher stock valuations. The next is your long-term versus short-term focus. Institutional investors can influence the stock prices based on their investment horizons. The long-term investors, those with a long-term focus like the pension funds, endowments, they may contribute to the price stability by holding the stock for extended period of time, so thereby reducing the turnover and the speculative trading. The next is your short-term investors. The hedge funds and other institutions, they focus on the short-term gains, might increase the price volatility through the frequent trading and leveraging the arbitrage opportunities. The next is your market reactions to the institutional moves. Announcements of significant purchases or sales by institutional investors can impact the stock prices. For example, buying announcements. When a well-known institutional investors, they buy a large stake in a company, it can lead to a positive price reaction and other investors interpret this as a vote of confidence. The next is your selling announcements. Conversely, the significant selling by institutional investors might trigger a negative price reaction as it may signal the potential issues or reduced confidence in the stocks. Event driven impacts. The institutional investors, they often react to the corporate events like earning reports, mergers and acquisitions, the regulatory changes. Their collective action in response to these events can actually cause a substantial price movements. For example, earning surprises, positive or negative earning surprises can actually lead to sharp price movements as institutional investors adjust their positions based on the new information. The next is your corporate announcements. The major announcements like mergers or strategic partnerships can actually lead to a significant price changes as institutional investors reevaluate the company's prospects. The role in IPOs and the secondary offerings. Institutional investors are major participants in initial public offerings and secondary offerings. Their involvement can actually influence the pricing and the success of these offerings. A high level of institutional participation is often seen as a positive signal, potentially boosting the stock prices post offerings. So we can say that institutional investors, they play a very critical role in shaping the stock prices through their substantial market presence, investment strategies and active engagement with the companies. While their actions can both stabilize or destabilize the stock prices in the short run, and their overall impact tends to promote the market efficiency and a better corporate governance, contributing to a more accurate and sustainable stock valuations in the long run. Now we will see what is the impact of the institutional investors and the market liquidity. This is also a very important topic to explore. Institutional investors, they significantly influence the market liquidity, which is the ease with which the assets can be bought or sold in the market without causing a significant change in their prices. So, there are several ways in which the institutional investors impact the market liquidity. The next is your volume and trading activity. Institutional investors are among the largest participants in the financial markets, often engaging in substantial trading volumes. This high level of trading activity directly contributes to increased liquidity by ensuring that they are always buyers and the sellers in the market. Their presence helps facilitate a smoother and a quicker transaction, reducing the time it takes to execute the trade. Out of this, the first P we are going to discuss is a bid-ask spread. The bid-ask spreads is the difference between the price a buyer is willing to pay, that is bid, and the price a seller is willing to accept, that is the ask. Now, high liquidity influenced by the active institutional trading, it generally leads to a narrow bid-ask spreads. Narrower the spread ask reduce transaction cost for all the market participants and indicate a more efficient market. The next important aspect what we are going to discuss is the market depth. Market depth refers to the market ability to absorb the large orders without significantly affecting the price of the asset. The institutional investors enhance the market depth by placing a large buy and sell orders, providing a buffer against the price volatility caused by a large trades. Now, this increased depth helps in stabilizing the prices and improves the overall market efficiency. The next is your stabilization of the prices. Institutional investors can help stabilize the prices through their trading strategies. For instance, during the period of market stress, they might provide a liquidity by purchasing the undervalued stock, which can really help prevent the further price declines. Conversely, they may sell overvalued stock, helping to temper the executive price increases. The next is your algorithmic and high frequency trading. Many institutional investors, they use the algorithm and high frequency trading strategies. Now, this automated trading systems can actually execute the large number of trades in fractions of a second, providing a continuous liquidity to the market. While HFT, that is the high frequency trading, it is a very important aspect to delve into. It can increase the liquidity, but it can also contribute to a short term volatility and flash the crashes if not properly managed. The next is your market making. Some institutional investors, they act as a market maker, committing to buy and sell certain securities at publicly quoted prices. The market makers play a very crucial role in maintaining the liquidity by allowing being ready to trade, thus ensuring that there is a continuous market for securities. Impact on the different market segments. Institutional investors' impact on liquidity can actually across different market segments, that is a large cap stocks. Typically, the large cap stocks are more liquid because they are more widely held and actively traded by the institutional investors. The small cap and emerging market stocks. These stocks often have a lower liquidity due to a less institutional interest. However, when the institutional investors do participate in these segments, they can significantly enhance the liquidity and attract more investors. Now, let's see what role the institutional investors play in the primary markets. In the primary markets where the new securities are issued, institutional investors are the key players. Their participation in initial public offerings and secondary offerings, it provides the essential liquidity, ensuring that these securities are successfully distributed and traded. Their involvement often boosts the investor confidence and the market liquidity. The liquidity provision in the bond market. In the bond market, institutional investors such as the pension funds, insurance companies and the mutual funds, they are major liquidity providers, and their large scale buying and selling of the bonds facilitate a smoother trading and a better price discovery, especially in the less liquid segments like corporate bonds or the mutual bonds. What impact it has on the regulatory changes? Let's dwell into this. The regulations affect the institutional investors. They can have a significant implication on the market liquidity. For example, the Basel and the solvency. These regulations impact the banks and the insurers' capital requirement, influencing their ability to provide liquidity in the market. Then we have Dodd-Frank Act. The legislation affects the trading practices and the role of institutional investors in the derivative market with the potential ripple effect on the liquidity. Now is the security lending and the short selling. Institutional investors, they can often engage in securities lending, providing their holdings to the other market participants for the short selling. Now, this activity enhances the market liquidity by increasing their availability of the securities for borrowing and trading, contributing to more efficient price discovery and the market stability. So, we can say that the institutional investors, they play a very important, pivotal and a key role in enhancing the market liquidity through their large trading volumes, market making activities and participation both in the primary and the secondary market. Their influence, it helps reduce the transaction cost, narrow bid-ask spreads and stabilize the prices, contributing to more efficient and resilient financial markets. However, their impact can actually vary across the different market segments and the asset classes, and the regulatory changes affecting their activities can have a significant implication for the market liquidity. Now we also talk about the influence what the institutional investors have on the CSR, that is the corporate social responsibility. The first is the engagement and the dialogue. Institutional investors engaged with the companies on CSR matters through a direct dialogue, shareholder meetings and the formal engagement programs. They use their influence as the shareholders to advocate for improved ESG practices such as an environmental sustainability, diversity, inclusion and the ethical business conduct. The next is your proxy voting. Institutional investors exercise their vote to support or oppose the shareholder proposals related to CSR issues. And of course, the next is your stewardship principles and the codes. Institutional investors adhere to the institutional principles and the codes that outline their responsibility and as long as the investors. So, these principles they often influence and include the commitments to engage with the companies on the ESG issues. It promotes the sustainable business practices and exercise the voting rights in line with the shareholder long-term interest and adherence to the stewardship principles, reinforcing the importance of CSR with the investment community. The next is your collaborative initiatives. The institutional investors collaborate with the other stakeholders, including the other investors, NGOs, and the industry groups to address the systemic ESG challenges. The collaborative initiatives like Principles of Responsible Investment, Climate Change 100 Plus, and the Task Force on the Climate Related Financial Disclosures, they amplify the influence of institutional investors on CSR by fostering the collective action and setting the industry standards. The ESG disclosure and reporting. The institutional investors they advocate for greater transparency and the disclosure of ESG related information by the companies. They encourage the companies to provide comprehensive ESG disclosures in their annual reports, sustainability reports and other communications with the investors. So, we can say that enhanced ESG reporting, it enables the investors to make a more informed decisions and holds the companies accountable for their CSR performance. So, that is how it is very important about the shareholder activism. The institutional investors may engage in the shareholder activism to drive the change on the CSR issues. They may also file the shareholder resolutions, nominate the directors, and advocate the specific CSR initiatives at the company's annual general meeting. And of course, the shareholder activism can be catalyst for a corporate change and encourage the companies to adopt more robust shareholder practices. Thank you so much.